Welcome to the deep dive, everyone. So let's start things off today with a pretty mind-bending contrast. How does a company with a massive, just mind-boggling $1.37 trillion valuation square with the fact that its core products revenue is actually shrinking?
Yeah, sounds like a paradox, doesn't it? I mean, in traditional markets, those two facts simply cannot exist in the same universe without, something breaking.
Exactly. And yet here we are in April 2026 looking straight at it. The mission of today's deep dive is to really figure out what investors are actually buying when they buy Tesla right now. Are they buying a struggling capital-intensive car manufacturer fighting a brutal price war? Or are they buying like a futuristic AI monopoly that's about to reshape global infrastructure?
Right, those are two totally different companies. And to figure this out, we're looking at two highly comprehensive financial reports from April 22, 2026. The first is the TSLA Deep Value Intelligence Report, and the second is the Tesla Financial Research and Analysis.
Both are essential here because they force us to look past the daily headlines, right? One uses a strict, autonomous, multi-agent framework to assess intrinsic value, while the other breaks down the operational mechanics of their latest strategic pivot.
You do, and it's a stark contrast when you put them side by side.
Yeah. But before we try to solve that trillion-dollar paradox, a quick but important housekeeping note for you listening. All analysis in this deep dive is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Always good to keep in mind, especially with a stock like this.
Right, disclaimer out of the way. Let's look at the actual numbers because the surface level narrative and the underlying financial architecture are pulling in two very, very different directions.
They absolutely are. And the defining tension of the company today is, well, it's an identity crisis. Management is actively trying to move away from being a traditional automaker, repositioning the company as what they call a physical AI powerhouse.
Okay, let's unpack this a bit because to really understand that massive valuation, we have to look at how that identity crisis is playing out in the physical world. Let's look at the Q1 2026 data. Revenue came in at about $22.38 billion.
Which actually beat Wall Street's consensus slightly.
It did, yeah. But when you look under the hood at the operational data, a glaring, heavily physical issue emerges.
You're talking about the production versus delivery gap.
Right. In that first quarter alone, they produced over 408,000 vehicles, but they only delivered about 358,000. That is a massive discrepancy.
It's huge. I mean, it's a delivery miss of roughly 7,600 units below consensus. But more importantly, from a purely operational standpoint, it means they built up an excess inventory of over 50,000 cars in just 3 months.
And this is where we have to talk about the mechanics of inventory. Building up 50,000 cars in inventory is like throwing a massive expensive dinner party and having 50,000 extra guests worth of food left over. Like, where does it all go and who is paying for it?
That's a great way to put it, because building 50,000 unsold cars is like buying massive amounts of ice without a freezer. It's not just sitting there idly, it's actively melting. Every single day, an EV sits on a dusty lot, the battery degrades, the software ages, and the eventual sticker price has to be slashed to move it.
It's a ticking financial time bomb, basically, not just trapped capital.
That is the perfect way to look at it. Cars sitting on lots are essentially cash that has been set on fire until a buyer comes along. You have working capital locked up in steel, aluminum, lithium.
Yeah, and you're paying lot fees, storage fees.
Exactly, the logistics cost to shuffle them around. And while those 50,000 cars are sitting there depreciating, they are simultaneously pouring massive, unprecedented amounts of capital into AI infrastructure.
Right. They're currently building out the Cortex-2 compute cluster.
Okay.
And this is a monstrously expensive artificial intelligence training supercomputer. So they have this massive oversupply of physical cars eating up their margins, but they're spending their actual cash reserves on digital brains.
Precisely, because management is intentionally shifting the focus away from vehicle volume. The future, in their eyes, isn't selling a steel box on wheels, it's software. Specifically, the full self-driving, or FSD, subscription.
Which is a huge pivot.
It is. By late 2025, they hit 1.1 million active users paying $99 a month for that service. This is the data flywheel moat they talk about.
Wait, hold on. Let's do the math on that. Even with over 1 million subscribers, 99 bucks a month is roughly what, 1.2, maybe $1.3 billion a year in recurring revenue?
Right around there, yeah.
But automotive revenue is over $20 billion a quarter. How can a billion-dollar software stream possibly plug a multi-billion-dollar hole in hardware sales and fund a supercomputer at the same time?
Well, on a pure dollar-for-dollar basis today, it can't. You're right. But you have to look at the mechanism behind the software. What management is banking on is that data flywheel. They have nearly 9 million vehicles on the road right now. Think of those cars not as products, but as a distributed sensor network.
So every time someone drives to the grocery store, the car is basically working for them.
Exactly. Every mile driven feeds visual and kinematic data back to headquarters to train the neural network. The better the neural network gets, the better the FSD software gets.
And then more people subscribe.
Right, which in turn generates even more data. This feedback loop is what culminated in the June 2025 launch of their robotaxi service in Austin. Their ultimate goal is to completely decouple their valuation from the cyclical, heavy metal automotive market and attach it to the recurring, ultra-high margin revenue of software as a service.
Here's where it gets really interesting. The irony is that funding this massive Cortex-2 AI supercomputer requires immense free cash flow that historically comes from selling cars.
Right, the very cars they are trying to pivot away from.
Exactly. Which brings us to the massive hole in their current financial strategy. If that AI and software story is the future, the actual financial growth metrics funding that future are flashing red across the board right now.
The transition from hardware to software is incredibly painful. When we move from the grand narrative to the hard numbers in these reports, the picture changes dramatically.
Yeah, the numbers are pretty sobering. Revenue growth is actually shrinking. It's down 2.9% year over year. That is the first time we've seen a contraction after years of explosive, seemingly unstoppable expansion.
Yeah, it's a real shock to the system.
And it's not just revenue stalling out. Net income dropped over 46% year over year.
And the profitability deterioration is severe. I mean, we've seen their gross margins, which peaked beautifully around 25% back in 2022, compress all the way down to about 18%.
We definitely have to talk about why that compression is happening. A lot of that is due to the brutal EV price wars, especially in China, where competitors like BYD are just relentlessly aggressive.
Oh, BYD is the perfect example of why margins are bleeding. They achieved something incredible over the last few years, which is total vertical integration.
Right. They don't just assemble the cars.
Exactly. They manufacture their own batteries, they produce their own microchips, and they even mine their own lithium. Because they control the entire supply chain, their cost structure is incredibly low.
So when the macroeconomic environment gets tough, BYD can afford to slash prices and still turn a profit.
Precisely. And to keep their market share from collapsing in China and Europe, the only defensive lever left is to cut the price of their own cars. But every time you cut the sticker price of a Model Y by $3,000 or $4,000 to compete with BYD, that cut comes directly out of your profit margin.
Because there are no cost savings offsetting it.
Right, there's no buffer. So you end up with shrinking revenue, plunging net income, and rapidly compressing margins.
Wait, but despite all of that structural pain, the stock is trading at an astronomical 359x PE ratio. I mean, traditional automakers trade at a fraction of that PE. Are investors just completely ignoring the math, or are we looking at the wrong math entirely?
What's fascinating here is the classic value versus growth dilemma playing out in real time, right in front of us. If you judge this purely as an automaker today, you are absolutely right. The math makes zero sense.
It's completely disconnected.
But the market isn't pricing in car sales anymore. The hypergrowth phase of the 2010s, where they were scaling vehicle production at 50% a year, is definitively over.
So if they aren't pricing in cars, they are pricing in the Cortex-2 cluster. They're pricing in the robo-taxis navigating the streets of Austin.
Yes, the market is pricing in a highly speculative future, where they achieve monopoly-level economics in robotics and autonomy. A 359x multiple means investors are incredibly patient. They are willing to pay massive premiums today because they believe that earnings will explode exponentially once the software and AI businesses fully mature and the heavy manufacturing costs fade into the background.
So how does a strict numbers-based value investor look at a stock priced entirely on future promises? I mean, Warren Buffett and his disciples famously avoid companies where the valuation relies on unpredictable technological breakthroughs.
That brings us to the deep value intelligence framework in our sources. This report applies strict Buffett-style value filters to the April 2026 financials. And spoiler alert, it is a tough grading curve.
Oh, I bet.
When you strip away the narrative and just look at the cash, it's a completely different reality.
It is brutal. Let's look at the criteria they use. First, 10-year predictability. They score incredibly low there. Because, let's be honest, forecasting the regulatory and technological landscape for full autonomy and robotics a decade out is practically impossible.
Next, anyone's guess. Next is cash generation. It's not that they don't make money. They do generate free cash flow, about $5.8 billion trailing 12 months.
Which sounds like a lot.
It does, but you have to weigh that against the price tag. Relative to a $1.37 trillion valuation, that's a free cash flow yield of around 0.4%. If you're a strict value investor looking for immediate cash returns, that is extremely expensive.
And then there is the valuation discipline filter. Based on this report's base case discounted cash flow, the DCF, it intrinsically values the stock at just $53 a share.
Let that sink in for a moment. The fundamental cash flow-based intrinsic value, what the business is actually producing today, is roughly $53. Yet the market price they are trading at is around $388.
Meaning there is absolutely zero margin of safety. The final AI-generated investment stance for a value investor from this framework is a hard all-caps avoid.
Right. They calculate that to justify the $388 price today, the company would need to succeed not just as a profitable automaker, but as the dominant global AI and robotics platform.
Which is a tall order.
Exactly. It's certainly possible they pull it off, but for a value investor, it's entirely speculative. It relies on things going perfectly.
So what does this all mean? Buying right now, from a value perspective, feels like buying a lottery ticket that already cost the exact price of the jackpot. You're paying for perfection up front.
I like that analogy.
Right. Because if they pull off the robotaxi monopoly and dominate physical AI, you merely break even on your initial expectations. If they hit a regulatory speed bump, or the technology takes 5 years longer than expected, you lose.
If we connect this to the bigger picture, it's vital to clarify that this verdict does not mean it's a bad company. Far from it. They boast world-class innovation, an unmatched data moat with those 9 million cars, and a fortress balance sheet with very little debt.
Yeah, we can't ignore that.
What the report is saying is that it's a bad price for a value investor. Knowledge is most valuable when applied properly. You simply cannot pay technology platform prices for a business that is currently suffering the cyclical margin compression of a heavy manufacturer.
That distinction is so important. The business quality and the stock price are two totally different conversations. But if the value verdict is a void, is there anything in the data that could save the fundamentals and shift the narrative back to watch or advocate?
Well, there are absolutely hidden wildcards in these reports, and the most tangible one is the energy generation and storage segment.
If you're listening to this, you might be asking yourself, what stands out to you? Is the Megapack the silent hero here that no one is talking about? Because when everyone is aggressively arguing about delivery numbers and robotaxes, this energy division is quietly printing money in the background.
It really is the silent engine of the company right now. In Q1 2026 alone, they deployed 8.8 gigawatt hours of energy storage.
Wow.
Yeah, and we aren't just talking about a few batteries in someone's garage. We are talking about massive megapack installations stabilizing entire municipal power grids alongside power walls in residential homes.
And according to the research, that segment now makes up over 13% of total revenue. Yeah. That is up from 10% just a couple of years prior. It grew 27% year over year in 2025.
And crucially, unlike the cars right now, it is highly profitable. We have to look at the macro environment here. The world is transitioning to intermittent renewable energy like solar and wind.
It would require massive grid-scale batteries, right, to store the power for when the sun isn't shining.
Exactly. At the same time, the AI boom is requiring unprecedented amounts of electricity to power data centers. Large-scale battery storage isn't just a green initiative anymore, it's essential infrastructure.
Right, it's a critical.
If that segment continues to scale rapidly, it could fundamentally alter the earnings mix, making them far less reliant on the low-margin, highly competitive automotive side.
That is a massive structural wildcard. But there is also a psychological wildcard at play here, the psychology of the market itself. The retail investor engagement remains incredibly high.
It really functions as a narrative stock where sentiment is driven by Elon Musk's messaging just as much as the balance sheet.
And speaking of Musk, the 2025 annual meeting is a key data point in these reports. That meeting saw the overwhelming approval of his massive performance award. So what that means, mechanically, is that he is highly aligned economically with shareholders.
Right. He receives zero compensation unless massive value is created for everyone else. Furthermore, the reports note he executed massive open market buys of the stock in late 2025, putting his own cash on the line at these high valuation levels.
Which sends a very strong signal to retail investors.
It does. But on the flip side of that retail enthusiasm, the traditional institutional money is treading much more carefully.
Yeah, the 13F filings show that traditional value funds like Viking Global or super investors like Josh Tarasoff have either trimmed their positions or are holding them at paper losses right now.
Because they're looking at the same inventory buildup and margin compression we are. This raises an important question. How much of that $1.37 trillion valuation is permanently tied to Elon Musk's unparalleled ability to build narratives and capture the public's imagination versus the actual structural health of the balance sheet?
That's the million-dollar or trillion-dollar question. The narrative acts like gravity, keeping the stock price up. But if the narrative falters before the physical AI products, like the robotaxi, reach mass commercialization, the downside risk is immense.
It's the ultimate corporate tightrope walk. They are essentially self-funding a transition into the next era of technology, using the shrinking profits of an EV price war to build the supercomputers that will supposedly drive our cars for us in the future.
And they have to achieve all of this flawlessly, while competitors in China continue to flood the global market with cheaper alternatives. And while regulators scrutinize every single move they make with autonomous driving software.
Exactly. It is a transition with zero room for error.
So as we wrap up this deep dive, I want to leave you with a final thought to mull over. We've talked so much today about the massive drag that manufacturing physical cars is having on margins.
Yeah.
The trapped capital, the depreciating inventory, the brutal price wars. Imagine if they stopped manufacturing cars entirely tomorrow.
Just walked away from it.
Yeah, imagine they just washed their hands of it. They avoided all those heavy factory costs, the supply chain nightmares, and the inventory buildups. What if they solely licensed their FSD software to other automakers and focused entirely on building AI data centers and deploying megapacks for energy storage? Would the company actually be worth more than it is today?
Wow, it's a fascinating thought experiment. Because right now, the manufacturing arm is the only thing funding the AI dream, but it's also acting as a massive anchor on the valuation metrics. Separating the two might reveal the true value of both.
Definitely something to think about as you watch this company evolve over the next few quarters. Before we go, if you want to run your own valuation models and dive deeper into this kind of financial analysis, I have a quick message to read. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to Explore and Join DeepValues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. If you like to access wider topics including life and investing philosophy, please subscribe to our sister channel Deep Values. Don't forget to like this video. Much appreciated.
Thank you for joining us as we unpacked all of this.
And just remember that opening image we started with, that massive $1.37 trillion price tag hanging over a dusty lot full of 50,000 unsold cars melting like ice without a freezer. The question isn't just what the company's worth today. The question is whether that valuation is a bloated price tag for a struggling car company or the cheap admission fee for a future we haven't quite seen yet. See you next time.